Okay, folks, this totally amazing video is going to be about bad debts. So I'm looking at the bad debt illustration that's part of your Excel file. And this fictitious company, XYZ, has $250,000 of accounts receivable. That's the total amount of money that's owed to the company by customers and clients and so forth, as of December 31, 2019. And they had $870,000 in sales. This is their first year of operation. What is this, you say? This is an aging of the accounts receivable. So if we assume that XYZ is selling net 30, which means they expect to be paid within 30 days, the current column would be the December invoices. 1 to 30 days past due would be November, October, September, August, and before. The older the receivable, the less likely it is that you're going to collect the money. So the total is, these are all of our clients and customers here, $250K. And then we use these percentages here. These are estimates. We are estimating that we will not collect 25% of the August and before, 10% of September invoices. And the percentages go down as the receivables become more current. This becomes our estimate of uncollectible receivables. And that is a total of $8,700. Now, why are we doing this? Well, because under generally accepted accounting principles, you have to try and match up the cost, which in this case is the bad debts, with the sales, which occurred in 2019. So how do you know which receivables are not going to be collectible? You don't know. So you have to estimate. You're actually projecting what your bad debts will be prior to it actually happening. So there's our guess, 8,700. Okay. How do we put that on the books, you say? This kind of entry. There's only 3 entries in this whole bad debt deal. This is the entry to record the expense. Okay, so now we have the expense on the books, and we have a credit to the allowance for doubtful accounts, which is a contra asset account. It's the second one we've encountered. The other one was accumulated depreciation. Okay. Now, hopefully this makes sense. We get the expense on the books in the same year as the sales. The sales were in 2019. Why don't we credit accounts receivable here? Because we don't know whose receivables to credit. Remember, whenever you change the balance in the main account, the controlling account, the general ledger account, which has $250,000 in it, you also have to change the balance in the subsidiary ledger, the individual amount owed by a particular customer. And we don't know who they are yet. We're guessing. Okay, so that's one entry. That puts your expense on the books. And what method do we use here? Well, it's an allowance method, and we did the aging of accounts receivable to arrive at our guess of bad debts. That's an estimate. Now, we go into the next year, which in this illustration be 2020. Here's our accounts, yeah? Here's our balance, $250 was owed to us. Here's the credit balance and allowance for doubtful accounts. If you take the two of these together and you net them, you get the expected realizable value, which is a fancy name for, here's the total amount owed to you. This is the amount you think you will not collect. And this is the amount you think you will collect. And of course, that's not going to be 100% accurate. All right, now we go into 2020, and 2 things are going to happen. Number 1, we're going to give up on some receivables. When you give up on a receivable, you make a write-off entry. They're all the same. Debit the allowance account. Why don't we debit bad debts? Because we already did that. We did that in advance of this. So this account is going to absorb all of the write-offs of the receivables. And it's called a write-off because what? You're taking this receivable off the books now. You're writing it off. There's 3 of them here, okay? And then the other kind of entry, which you're going to see in problem 91A, I'm going to do that next, is a reinstatement. In the real world, this hardly ever happens because companies, they don't like to write off receivables in the first place until they're absolutely, completely dead. But what happens here is you already wrote off this company O, over here, and then you are surprised. Why? You got $1,700 from this company after you wrote them off. So you flip this entry, bring the receivable back to life with a debit, credit the allowance account. Now you have a receivable of $1,700, collect the money. That's just a standard collection from customer on account. Okay? 3 entries. 1 to record the expense. That's this one here. Bad debts, allowance for doubtful accounts. And then you have write-offs and reinstatements. This is one of the allowance methods. And we use the aging of accounts receivable to come up with our estimate of $8,700. Okay, so that's how it works. Now, let's take a look at problem 91A, which is very similar to Milo Tindolini, which is one of the assigned problems, okay? So I typed some stuff in here so you don't have to watch me fumbling about with my poor typing skills. Okay, so here's the story with 91A. It says on December 31st of the current fiscal year, okay, we're looking back at all these different transactions. So in January 29th, towards the beginning of the year, they received 35% of $9,000 from Kovar Company, which is bankrupt, and wrote off the remainder. Okay, so this is 91A on page 476. So what do? Well, first of all, we collect the money. How much money are we going to collect? And I have the account titles to the right here. Again, so you don't have to watch me fumbling about. So these are going to be our 2 entries here. This is a write-off. First of all, it's a collection of X amount of dollars, and then it's a write-off of the remainder. All right, so we collected 9,000 times 35%, 3,150. And the rest, the balance of that receivable is going to be a write-off. So that's going to be 9,000 times 0.65, which is the complement of 35. These 2 numbers should add up to $9,000, and it looks like they do. And there's our first write-off entry in this problem. We wrote off the balance $58.50. So we get to the instructions below, you're going to find out that they started out with a balance of $54,200 credit balance at the beginning of the year for the allowance for doubtful accounts. Okay, so that $58.50 goes over here on the left side of the allowance account, and we're hoping that the balance in the allowance account is sufficient to absorb all of the bad debts that occurred during the year, all of the write-offs. What happened next? We reinstated an account, Spencer Clark. We received $4,000. This hardly ever happens in the real world, but it happens twice in this problem. So these are going to be our debits and credits. Okay, first you have to bring the receivable back to life. How much? 4,000. Then we collect the money. This is standard collection on account. Debit your favorite account, cash. Credit the accounts receivable. And the observant student will note that the credit to the allowance for doubtful account has been posted over here. It's a reinstatement. So you're going to have write-offs on this side, and we're going to have reinstatements on this side, which is the credit side. Here we go. What happened next? We wrote off the Iron Horse Company. It's going to be another one of these transactions, right? Debit the allowance, credit the receivable. Let's go get Iron Horse over here. Here he is. Here's our entry. Debit the allowance for how much? $11,850. And away we go. What happens next? Another reinstatement. $7,000 from Vinyl Company. That's just going to be another one of these, right? Bring the receivable back to life. Collect the money. Let's go get those debits and credits over here. This is the old Vinyl Company. Okay. All right, there's the receivable being brought back to life. For how many dollars? $7,000. Got to put the comma in here. I won't be able to sleep tonight. Here we go. All right. And then collect the money. Zip, zip. Bring the receivable back to life. Collect the money. All right, so now we got another $7,000 on this side, which is the reinstatements. Brings us to December 31st, and I guess right before the year-end New Year's Eve party, we're gonna have a little write-off party. And what are we writing off? We're writing off Connolly, Divine, Moser, and Oceanic Optics. That's going to be this entry here. I just got one debit to the allowance account. The individual receivables are $12,100. Okay, so the total of the write-offs, let's make sure I put in the right numbers, 12,100, 8110, 21,950. Okay, that looks good. The total of those write-offs is 52,160. Could you have made 4 debits? Yes, of course you could. Wouldn't be necessary, however. All right, now we're at the end of the year, and it says they did an analysis of accounts receivable, and they estimated that $60,000 will be uncollectible. They said an analysis of accounts receivable, that's the same thing as an aging of accounts receivable. So what's the balance in the account? Well, you got to add up the debit and credit sides and figure out which is greater, and it must be the debit side, because that's where I have the little box. And 4660 is the debit balance. What does that mean in English? Well, it means that you somewhat underestimated the bad debt activity during the year. So if you net out all this stuff here, these being the write-offs and these being the reinstatements, it nets out to this number, 58,860, which is greater than the guess. That's an estimate, right? 54,200. Now, in the real world, this never happens because each month you make entries to continually increase the allowance account. If you didn't do that, you would only have bad debts in 1 month of the year, which would be December. So your financial statements would be out of whack from January through November. But we're not going to let that bother us right now. Okay. So now what? It says, well, we're using the aging or analysis method, which means we follow this approach. It's called the balance sheet approach. We want the balance in this account to be $60,000. So you say to yourself, well, if I have a debit balance of $46.60, just to get to zero, I'm going to need $46.60. And then I'm going to need another $60,000 because I want that to be the balance. And there it is. There's your balance. So if you had a debit balance, you need $46.60 just to get to zero. Now we got the balance of $60,000. What do we do with this number? Well, I got it on the wrong line here. What we're going to do with this number is we're going to use that for our adjusting journal entry. The one to record bad debts. Okay, so here it is. The entry we calculated needs to be $64,660. Debit the expense, credit the allowance account. And if we want to calculate the expected realizable value, what do? We just take the receivable balance of $1,450,000 and subtract out, that's a credit balance, the balance in the allowance account. It gives you your expected realizable value of $1,390,000, and that's the number you're going to find on the balance sheet, the expected realizable value. So, you just go back over here for a second. When you use the aging or analysis of accounts receivable, and you're going to make this entry here to record your bad debts expense, you use whatever number will create the desired balance in this account. So the goal is to get a balance in this account equal to your estimate. It's a little different when you use the percentage of sales method, which we're going to deal with, which is instruction number 4 in this problem. Okay, so I think I already copied all the stuff down below, so let's see what this looks like. Well, look at that. Okay, now the observant student will note that all of these entries, what entries? All the write-off and reinstatement entries are identical regardless of which method you use to estimate bad debts. Which means what? If you assume the same beginning balance, which we are, you're going to wind up with this debit balance in the allowance account prior to adjustment at the end of the year. Okay. Now under this method, it's pretty quick and painless. You don't have that big aging schedule. You just take a percent of sales. The problem says use 1/2 of 1% of $13,200,000. So that's going to go down here. What do? You multiply 13,200,000 times 1/2%, which in decimal form would be 0.005, and you get $66,000. So having made that calculation, that becomes your adjusting journal entry. Now if we plugged in over here, our adjusting journal entry, it's a credit to the allowance account, we wind up with a balance of $61,340. Now what happened? What was different there? What was different was in the last estimation, we made the balance in the account equal to the estimate. Put that in here. That's if you're using the aging method, so-called balance sheet approach. If you're using percentage of sales, you might say that you make this entry here without regard to the balance in the account. But that's not entirely true, because in the real world, if you had a debit balance which again would never happen because you'd be making monthly entries. But let's say you had a debit balance. You'd probably increase your percentage a little bit. So maybe that was 0.4% last year. Now we're going to bump it up a little bit because it looks like we underestimated. All right, so then you multiply, you get your number, that's your entry. What is the balance? Well, the balance is mathematically whatever it turns out to be. You take your debit balance, sprinkle in your $66,000 credit, Walenda, $61,340. If you want to calculate your expected realizable value, what do? Same thing we did last time. Take the $1,450,000, subtract the $61,340, and that's a bingo. That's your expected realizable value. Now this problem kind of falls along the same lines as the Milo-Tindolini problem, but the Milo-Tindolini problem is just 1 month, which is much more practical in terms of real life. You're going to start with a $49,000 800 credit balance, and you got a bunch of write-offs. Wrote off the Islanders, those thugs on ice, right? Lamco, Weinberg, and another company here. And then you got a reinstatement. And then, of course, you wrote off the Mets. So you begin the same way you did with problem 918, which is you have a credit balance in the allowance account. You do some write-offs, you do a reinstatement. The end of the month, which is January 31st, 2020, you calculate the estimated amount uncollectible. It's $48,000. So in letter A, what are you doing? In letter A, you are doing the write-offs and reinstatements during the month. In letter B, you're just figuring out what's the balance in my account prior to any adjustment. The number in this problem was $46.60 debit. That's not going to happen in the Milo-Tindolini, but it's going to be a credit balance. Okay, now you have that set up. You make your entry for bad debts. If you're using the aging method, you know when you're done what's got to be the balance in the account. $48,000 credit. Number 2, C2, what's the balance in the account after adjustment? It's what you just made it, $48,000. Expected realizable value, what do? Take your receivables total, subtract out the balance in the allowance account. Then you come over here, in letter D, you play make-believe. Well, make-believe that you're using the percentage of credit sales method. And do the same 3 things. Prepare the bad debt expense entry, figure out the balance in the allowance account, figure out the expected realizable value. And there you have it. So I'm going to send this out to you all. So you'll have this over here. And then you'll be able to hopefully deal with Milo-Tindolini. And I think it's 9.4a is another problem. Alrighty then. Until next time.